Welcome everyone to the webinar on corporate lending that IBS is hosting in collaboration with Finastra. I am Nikhil Gokhale and I'm the head of research at IBS Intelligence. I have close to 2 decades of experience advising large financial companies on strategy, technology, and performance matters. Look, as individuals, all of us deal with banks. So we know how technology is really changing the way we interact with banks, right? Earlier, I had to go to a branch maybe once a month or maybe twice a month. Now I don't remember when I last went to a bank. So everything happens online. But when it comes to the corporate side of things, not many have the direct exposure about how things work, right? And that's the reason why this topic becomes so important for all of us. It's going to give you an opportunity to understand what are the trends in a sector that is otherwise opaque to you as retail customers. Uh, look, traditionally corporate banking and specifically talking about corporate lending has been a very relationship driven business. And the rate of technology adoption has been relatively slower. But the pandemic changed a lot of things, and this was one of the things that it changed. It accelerated the adoption of technology in this sector as well. And banks have been implementing technology rapidly on the corporate side, on the lending side. And the keywords, of course, are no surprises there: data and technology. They touch all aspects of corporate lending, right from assessing the credit risk to the cost of operations to the relationships, the client relationships, and how they are managed. And today we hope to cover all of that and give you some perspective, some insights of how that's changing. On the panel today, I have firstly Arvind Vairavan. Arvind heads the corporate lending solution for APAC at Finastra. With over 18 years of experience in the banking and financial services industry, he is a guru when it comes to corporate banking, originations, syndications, project finance, and of course, digital transformation. Prior to Finastra, he was a part of 2 leading investment banks, and he holds a master's degree from Rutgers University in the US. He is also a member of Asia Pacific Loan Market Association, and he has contributed significantly to developing solutions for the emerging markets. Welcome, Arvind.
Thank you, Nikhil. Hello, everyone. Good morning.
Next, I have Chidambaram Iyer, a banker cum risk specialist. Chidambaram has a wide spectrum of experience covering a variety of businesses and sectors. He's done credit cards, retail, SME, corporate, supranationals, multinationals, clearing counterparties, sovereign funds, I guess pretty much all of it, right? He has experience on multiple product coverages per se, including consumer and project financing, structured trade, derivative products, and loan syndication. At ANZ, he looks after the country and financial institutions risk across all the geographies that ANZ is present in. So welcome, a warm welcome to you, Chidambaram.
Thanks, Nikhil. Thank you.
Last but not the least, we have Jayanta Kumar Roy. Jayanta has 35 years of experience in banking across various functions, including business development, credit and risk, collections, process redesigning. He has held a number of senior management positions, including country head and business and credit risk head. Jayanta's areas of expertise include setting up end-to-end SME banking, including the risk infrastructure, frontline and operational processes. He's probably seen it all, right? He's seen the entire evolution. At Validus, he is a part of the management team, and he's currently overseeing the Singapore business and operations. So good morning and welcome, Jayanta.
Good morning to all. Thanks, Nikhil.
All right, so let's get started. Maybe with a warm-up question for the audience, right? I'm going to come to the first polling question, and that's the polling question. All right, So I hope you can see the question. The question is, corporate lending is undergoing a rapid transformation. And in your opinion, what is the biggest factor driving this transformation, right? Is it because end clients are shifting to digital business models? Is it because there is increased availability of automation tools? Or is it because of improved availability of alternate data? And lastly, of course, there is ecosystem partnerships, there is fintech. So what, according to you, is driving the biggest transformation? Let's give the audience a few more seconds to answer. I see that ecosystem partnerships and the digital business models are running very close in terms of, surprisingly, alternate data is yet to, oh, it's opened the score. Yeah, but I think, we will be talking about alternate data maybe towards the end of this session. People's views may change here. So, end the poll in the next 10 seconds. Ending the poll, sharing the results. Clearly, the ecosystem partnerships is coming right up there first, right? It is very interesting. It is definitely one of the most important things that is driving this transformation, and of course, the whole world moving towards digital business models. Yep, absolutely. And I guess by the end of the session, I hope that all of us and all of the audience members will know that maybe data is also as important. All right, so let's get started. I'm going to call upon Jayanta, I'm going to call him Arvind to tell us a little about Finastra solutions and how they are helping the corporate lending space. I'm going to start sharing the presentation that we have. All yours, Arvind.
Thanks, Nikhil. Thanks. And welcome everybody for this conversation that we have through this webinar. And interesting enough, I think I saw the poll on ecosystem. That's something that Finastra definitely believes in. And let me give you a little bit of insight of what Finastra does at a glance, so we know what we offer in the space. So we are a global powerhouse, right? Finastra is a solutions provider for financial institutions. And one of the numbers that I would like to touch upon would be that bottom middle number, where you would note that 71%, right? That 71% of the total syndicated loans are currently being managed by the Finastra solution, Loan IQ, right? And apart from that, you can see the other numbers there displayed, 5 trillion of AUM investment management, 6% of daily trade financing being processed by the Finastra solutions being in the market as well. Apart from that, right, what I would like to talk to you about is the growing presence in APAC. As we all know, right, the shift from Europe to Americas is coming into APAC. So in the APAC region, right, within the lending umbrella per se, over the past couple of years, you would note that some of our clients who are actively using the lending solutions offered by Finastra, as you can see on your right, the leading Australian banks, and we've got our esteemed speaker from ANZ, Chidambaram, as well on this call. As you can see, the top 5 banks in Australia are using them actively. In China, as Nikhil, you mentioned earlier as well, sovereign bank, sovereign lending. So that's another component within the lending umbrella where we have clients using our components there. And of course, some of the other names, right, in Singapore, Indonesia, Thailand, Philippines as well. And in the bottom right, you would also notice the leading commercial banks globally operating the Finastra lending solutions to process their commercial and syndicated business. And this includes capital markets as well as middle markets. And why is that growing presence increasing as we speak? Well, within the Finastra umbrella itself, right, what we do is we actively talk to the different regulators, right? We are always participating in conferences. We're also finding out from our clients and ensuring what drives or what kind of requirements are needed in the future. So our roadmaps are not really per se vendor-centric. We listen to our clients and ensure that our strategy of what we build to the future solutions and upgrades and all that are geared towards clients' requirements. right? This is where even for the aspects of LIBOR transformation, we were ready in 2019 November itself, because we were very active in that space. Looking at a little bit of the digital lending in nature, I mean, you would obviously notice, right, the pains in the market, right? Traditional versus digital. I think, as Nikhil rightfully had mentioned, digital is where everybody is moving towards, right? Everybody, like our, normal retail clients, or even ourselves as consumers, right? We want to have access to information readily available, right? Corporates, borrowers are getting a lot more savvy. They want to ensure that they get that information, they have that different kinds of sophistication. And at the same time, risk is another key factor, right? Everybody is looking at risk, right? We don't want to have, I would say, banks do not want to have to get into that mechanism of getting fines if these risks are not prevented. And of course, regulatory compliances, data is key, big data, and data which is accessible perhaps even through a cloud mechanism as well. And at the same time, what also happens is all the banks are also trying to ensure that the high cost is going to get reduced, and the speed to decisioning, especially for origination, is getting faster, because there's a lot of technology such as robotics, OCR, machine learning, which gives you a lot more information which is accessible and can be absorbed by the banks itself. Okay. So looking at an end-to-end mechanism, right? Three major components typically in the lending space, right? So we would definitely have the CRM origination, right? And within that, we have the various aspects of incorporating the relationship management between the corporates, the RMs, and all the different information we need to get absorbed for creating that necessary decisioning, which also happens in that middle stage where the analysis happens, the scoring of mechanism happens, and especially for syndicated deals, book running and underwriting requirements are also necessary, which is where the different kinds of tools which enable that is also being digitalized so that the investors can see information as soon as possible and try to show their appetite within that market as well. And of course, last but not least is of course the servicing, because any one of these deals, right, can operate from anything from 1 year to 20 years. So as we go into the future, they need to have the comprehensive capabilities where they can ensure that the transaction of servicing is able to be captured and serviced by the solutions which they have within the bank, leveraging upon any kind of fintechs to give that smooth end-to-end journey as well. So in the perfect world, of course, you want to have all three of this speaking to each other, having that two-way mechanism of interfacing, giving that access of information of portfolio to the bank level, as well as the global, or even by the different kinds of silos as well. Moving forward, so as your polling question earlier as well, the ecosystem, right? So in the Finastra side of things, right, we believe in delivering the future of financial services, and we have in fact ventured onto this journey of open platforms for innovation, i.e. ecosystem in play, right? So if you look at this specific diagram, our strategy for this is fusionfabric.cloud. So essentially, if you think about it like a cloud thing, like an Apple, right? App Store, right? The bottom panel where you notice, right? Within the Finastra umbrella, we've got retail banking components, software, we've got corporate banking. Today's conversation is on lending, of course. We've got the different core solutions which are available as a vendor we provide for. But we also realize that there's a lot more innovation outside of us, right? The likes of our competitors, our fintechs, Finastra developers, university students, even in the banks itself, they have the ability to leverage the different types of open APIs that we provide and ensure that we can actually expand on the capabilities of end-to-end lending. This is where the ecosystem comes in the picture. They can leverage this information and then at the end of the day, interface that into the core systems as well, or sell it independently to other banks or corporates who would need these different types of applications through the Fusion Store. And this is where, as I mentioned, that ecosystem comes into the picture. And you would notice here on a very high level mechanism, right? The lending platform for ecosystem. If we look from lead generation up to the distribution side, you can notice in the middle buckets is where the typical, I would say, bands of lending happens: lead generation, pricing, credit analysis, approvals, syndication, book running, servicing, distribution. So we realized that, okay, we are going to be focusing upon the core systems which we are very good at. And instead of building upon certain things which are readily available in the market, let's say, for instance, for syndication and book running, we have partnered with Hubex, right? Leveraging upon the ecosystem. Hubex itself comes with the state-of-the-art capabilities for syndication and book running. And perhaps, let's say, some clients say, hey, you know what, especially nowadays, they want digital signatories and such. We have DocuSign, so we partner with them as well, where we can incorporate the digital signatories components. And again, of course, you can see some of the other names in there: Microsoft Dynamics, Salesforce. We've got Fusion Lendercom, which is information published for lenders on a digital cloud platform as well, where access of information is readily available. And this is where, again, like I said, we would like to venture on that mode where we start incorporating a lot more fintechs, plug it in together so we can be the orchestrator of end-to-end lending. Okay. Moving on, if you notice a last messaging house, like I mentioned, we would like to have the orchestration, the noise of lending into harmony. So in essence, right, the future of finance is open, and Finastra wants to be the orchestrator of this open finance for end-to-end lending to provide to our clients. And this is where, again, Nikhil, I will pass it back to yourself so that we can get into our conversations with Jayanta, Chidambaram, and yourself. I hope it was useful. Thank you.
Well, thank you, Arvind. I think it was great the way you gotten us started. I think lots of interesting insights there, and I think in many ways the first poll question that we had and we spoke about ecosystems. Your presentation really mirrored how this is one of the biggest things, right? And yeah, I think thank you for getting us started there. I'm going to stop sharing my screen quickly, and let's get straight into the heart of the topic today, right? Let me get a banker's perspective. Jayanta, I'm going to turn to you first. How is credit evaluation, I mean the heart of lending, right? How has credit evaluation changed in the recent years, and how has it been different for small companies or large companies, for example, right? Over to you.
Thanks a lot, Nikhil. Actually, Arvind has opened the entire vision. I would not say the Pandora's box, but the entire spectrum of how things were and how things will be. And in fact, the first polling question was interesting. Yeah, a lot of respondents talked about digital. Less of them talked about data. So I'll start from there because as we go into the digital journey, data and digital are like the two sides of the same coin. We don't realize that when we start the digital journey, but they're two sides of the same coin. Otherwise, only digital will be like a first generation ATM, a man behind the machine. You put your ATM card for 50 years back, a man will count the notes and give it to you. So in that respect, the entire evaluation of the credit has changed. And not only for the entire corporate world, starting from the micro to the largest syndication. My specialty has been for the lending of medium, small, and micro space. Now, the way things are being done in the last 2 years, in fact, we started more than that, but COVID has taught us that there is much more data available everywhere rather than what the borrower serves. Gone are the days when we would take financials. 5 years, this was a banker's sweet hobby. Give me the 5 years financials with all aging list and account payable, account receivable, and somebody will sit down 24 hours a day. Those days are gone. In fact, for the small and medium space, not only banks, most of the fintechs do not take financials. Like we don't take financials. Financials are history. What happened in 2020 or 19 pre-COVID is no reflection on the way this company is going to perform in 2021, 22. In 90s, we used to look at 10-year cycle. After the Lehman Brothers crash, we looked at 5-year cycle. Now we are looking at a 1-year, 2-year cycle. So 2-year, 3-year-old financials are history. What do we want? We want real. So that brings me to the core of credit analysis, where I would touch on 3 points: real-time data and machine learning. Both goes hand in hand again. The person or the company or the owners who are driving the business. It is the man behind the company, or the way I call it, the horse which is driving the carriage. Carriage is the company. Trade, I'll touch a bit about trade also. How trade can be affected. From the borrower or from the prospective borrower, if you look at the bank statement and do a machine learning analysis on that, the last 6 months, last 12 months, you will get a plethora of interesting stories. And maybe that may much differ to what the financials is projected or given to you. Couple on top of that, lots of credit bureau reports available from the credit bureau about the company, about the business, about the transaction with their peers. That gives you enough amount of data. Couple them. It will take time, maybe 6 months, 12 months. You have to run 100 cases through your model. Then the machine will be able to churn those and give you a much more holistic and realistic picture and credit analysis of the entity that has come to you from borrowing. Look at the financials, look at the credit bureau report, look at the projects that he's doing. Get those reports, get those populated digitally up, the projects. The OCRs will pick them and read them. Combination of these three will give you a much better projected cash flow that a typical lender looks. On top of that, this is a business. On top of that, the man behind the show. Dig out the credit bureau reports or the CBS, what you call in Singapore, in other countries, the CBIL score in India or the FICO score in US, whatever it is. On top of that, build this. That will give you what in typically in credit we say character, the C. Okay, but character is a big word. Character. We are not here to do characterology. It shows you the character of the propensity of the borrower to pay or default when the cash flow sucks. Nobody wants to default. People default when the cash flow sucks. And the cash flow part you've seen earlier. So now real-time data, machine learning I talked about. I talked about the person who is running the show. Very important. Mix all those things. No human can do it. It has to be digital. It has to be data-centric. It has to be agile. And the more data you fit in, your credit model will become much more efficient. Talking about a few jargons, the curve fitting may be 50-60% initially, but as you progress over the time, the curve fittings and the pies will all match to 80, 90, 95%. Now, no human I've seen in 35 years gives analyze a case with a 95 or 99% amount of surety. Machine can. In fact, interestingly, we are talking to some regulators. We're talking for trade financing with Ghana, Nigeria. Hopefully, we know where these countries are, and we know about Nigeria, Ghana in a different sense. But if you look at the trade, the transactions, the financing happening to the banks, the take away how the entire thing moves through the data, then there are good spaces to finance. Even Singapore or Indonesian company importing, you can finance. You know those people in Ghana will deliver through their data and the track record. Just to finish this, actually, it took us time. Over a period of 3-4 years, we have developed. Now our model, I would say, at 80-85% level, not 100%, 95% not yet maybe, where we just on a prospect onboards on our platform and only submit last 6 months bank statement. That's all. We take out the credit bureau reports of the company, earlier companies there are, the promoters, everything, the transaction, and flat 2 hours, we come out with approval or rejection, and approval is a limit, with pricing. Pricing is also given by the machine based on the risk rate. So you're pricing your loan, you're pricing your entity, and you're superimposing the pricing of the promoters on top of that. So that is the future. And I think MSME, medium, small, and micro balance sheet we should be more eco-friendly and stop asking them to produce balance sheet. Don't quote me. But the bigger ticket size, the corporate, multinational, there is a lot of scope. I guess Chidambaram will talk about that, where such information is also available. There are sites, there's Google, there's other things. And there's a lot of simulation that you can do there also. With that, I hand over to Chidambaram to take part of that site, which also is going through digital transformation, the large international borrowers. Yep. Thank you.
Thanks, Jayanta. I think that was a very exciting piece of, neo and modern style of looking at how credit evaluation is done. And I'll have to admit right now that my style of saying is a little bit old school, going back to the drawing board on how credit evaluation is traditionally done in banks. So as you all would have been aware that, credit evaluation is all about the 5 C's or the 8 C's that is called. So which is basically character, capacity, capital, collateral, conditions. And when you have cross-border, then it becomes country, currency, and culture. So if you look at it, any form of credit evaluation will have some aspects of all these characters. And therefore, whether it's an SME or an institutional entity, all of them, the analysis is core to these 8 characteristics that you need to assess before you decide whether you want to go ahead or not. Now, as Jayanta mentioned, SMEs, traditionally, if you look back 20 years back, we'll all wait for, the financials to come up and do something about it because there was no information available. But now if you look at it, you have so many data sources and so many avenues of information that not only can you do financial analysis quickly, you can also, have a fair bit of idea as to how the environment is, how the economic policies are, what is the market around, and what's the competition like to assess how this particular entity would do. Now, if we go further to the institutional field, institutions are large entities, and they're like, they are an organization on their own. This sector is, heavily covered. You'll find not only, equity analysts, you'll also find researchers who would be actually analyzing these entities. And as Jayanta mentioned, there's tons and tons of information available. You do a Google and you'll get so much of information that you'll be lost as to what information do I select and what not to select, which is another problem. So you could, look at, say, for an institution as to how it's doing globally, where are its prime markets, what will be the impact of stuff. And if we, related to the latest event of COVID pandemic, how has the pandemic impacted that, are some things which, if I look back about 20 years back, was very difficult to do with the tools that we had. But now if you look at it, now, for example, results are available on the nick of a time. It directly feeds into your financial analysis. And so you have all your financial ratios done at an instant. Apart from that, you will also get information on trade, as Jayanta was mentioning, what kind of business is happening, what kind of supplies, what kind of exports are happening, etc. Which, if you merge with your credit analysis, will give you a high amount of confidence as to what it does. Primarily, as a bank or a financial institution, what is it interested? It's interested in seeing how the cash flows of the entity are, how its business model is, and whether it will be able to service its debt in the short or medium term. And that's precisely now how you reach that conclusion. It could be by basis of your historical analysis or probably forward-looking trends. That's where technology and data comes in. And now with modern technology, you can actually figure out, have scenarios wherein just by a click of a button, you can figure out if so and so things happen, then what will be my analysis, whether the entity will be able to repay my debt, etc. So fundamentally, the credit analysis over the years has not changed. It's basically evaluating those 8 stuff. Now, the tools that we have on how we evaluate can change. And now with COVID coming in, it's become far more easier, and you have so much of data. And here again, I need to caution, because you have so much of data, it's very easy to find correlation, etc. And that's where an expert comes in to have to know the difference between when it is correlation and when it is causation. So I'd like to end here. Thanks.
Important point, right, Chidambaram? Because the whole point is that the data and technology are not making humans redundant. They're making them more specialized. They're making them smarter, right? Yeah, interesting. I think the gut feeling that a lot of times in the past, 20 years ago, decisions would be taken on gut feeling. I think that gut feeling is now slowly going away and getting replaced by data and technology, and that's the important thing. Machines and data is making the gut feeling go away and take decisions based on real information, right? So let me bring in Arvind here. Arvind, taking a step back even further, right? In the sense, we spoke about credit analysis, but how are the needs of lending needs of corporates? How have they changed over the past 5 years? And maybe focus more on the last 2 years as well. That's been a bigger shift there, right?
Indeed. Thanks, Nikhil. So absolutely, I mean, looking at what Chidambaram said as well, right? Absolutely, technology is something that even corporate clients know is out there. So there's a rising expectation of corporate clients' needs, right? Information which is readily available and where data can be at their fingertips. I mean, if you think about it, let's say, for instance, right? When a corporate client wants to know what kind of exposures they have, right? When a utilization needs to happen, right? They need to have that information ASAP, right? So there's a lot of technology advances where users can actually leverage upon mobile devices, iPads, to access this data, right? And be it not just for reviewing exposures, be it for the different types of approvals, requesting for drawdowns, payments, seeing what they need to do in the market. So those kind of things, I mean, information are available, and corporate clients like us, any consumer as well, wants to get that data ASAP, right? Apart from that, if you think about it, digitalizing access for borrower communication. So if we think about the old times, right, where any type of when an origination happens or communication needs to happen, right, between the corporates, what happens traditionally was that they had to actually physically request for that information, maybe through a phone call, maybe through an email, requesting them for a certain set of information so that the necessary analysis can be done. Whereas nowadays, corporate clients understand there are technology where it is secure, and using these different types of collaboration of open APIs, where information can be directly uploaded. See, for example, a document requested by a relationship manager can be requested online that gets pushed into a corporate portal, and the corporate portal personnel can actually review that. They know that there is a need from the RM for that specific information. They can then upload that document directly where the RM plus his other teammates would have that information versus it sitting in a specific email or it being faxed and so on. So that kind of shorter timelines for information to be sent across on that communication is something that a lot of corporates are looking to get as well. Again, even if we look at corporates, right, like what Chidambaram and Jayanta mentioned, right, they are smarter, savvier, and more informed because data is there, and they have a high degree of personalization requests and conveniences which are needed, right? They also expect shorter timelines for new deals to be originated, because if that data has already been provided and it can be absorbed through a central bureau, use these open APIs to absorb that information to get that analysis done ahead of time instead of having that lengthy processes, right? Corporates will also be able to want to interact post-close as well to self-service dashboards or portals where post-close, they can also see the different kinds of exposures, requests for information, do payments, which directly syncs into the different systems. I mean, if we think about it, right, in the COVID side of the things, previously, all these traditional methods were okay, but post-COVID, that digitalization component comes in the picture. I mean, There needs to be blanket approval of commitment lines because these businesses are being consolidated as well, right? The parent-child umbrella for utilization of funds across, multiple geographical locations. That's something that corporates are always looking for. They want to be able to make sure they have access to this liquidity when needed as well. And then if you think about the bank side, right? When we look at the bank side, right? Banks also need to be able to provide this kind of services to the corporates, right? They need to be able to white label the different types of dashboards, perhaps the login pages for the different subset of corporate clients. Maybe an AFL business is different, an SME business is different. So each subset of these corporate clients will also need the specifics which is needed in the market, and banks need to be able to provide these corporates that ability to white label and provide the necessary information for these subset of corporates as well. This is what I had for now. Nikhil, I hope that helps.
Yeah, absolutely. I think, so from what you're saying, I can clearly see that it's the experiences on the personal side are now, I would say, getting mirrored a lot. The expectations are getting mirrored on the corporate side as well, and maybe in a much bigger way, because it's global in nature. The multi-country requirements. So I think, yeah, that's fascinating that how the personal experiences are getting mirrored on the corporate side. All right, so it brings me to the second poll question. I'm going to start the second poll question. So what, according to you, will be the biggest benefit, now that you heard our speakers a little bit, what according to you will be the biggest benefit of this digital transformation? Is it the better understanding of credit risk? Will it be improved customer experience? Will it be better ability to comply to regulations? Or, of course, operational efficiency? I think the benefits are across all these four areas, but the idea is what's the biggest benefit, right? And I can see right now as the the live poll results that I can see on my screen, it's again neck and neck between credit risk and operational efficiency, and the customer experience is also catching up. So I think yeah, I think our participants do feel that the benefits are across the spectrum. 10 more seconds and we'll end the poll. Clearly, almost neck and neck. So I'm going to end the poll and let's share the results. As you can see, the three benefits are neck and neck, and completely in sync. I think the regulatory compliance will catch up over time, and that's also a very important aspect of what technology is doing, right? So, all right. So, staying with you, Arvind, right? Cloud, right? That's becoming a default for developing and deploying technology solutions, right? How important in your mind is being cloud ready when it comes to lending solutions? I know we spoke about how the lending will be a part of it, but what, according to you, is being cloud ready mean?
Great. So cloud ready, I mean, if we look at cloud computing, right? Cloud computing will be strategically important to all banks, I would say, for their current strategies, right? And it's not just for lending, it's for the end-to-end of their entire band-wide solutions that they have, right? Because why? I mean, if you think about cloud in nature, right? Cloud, using the cloud to scale, that's one of the most important mechanisms, right? Data storage costs have tremendously fallen, and facilitating this cloud-based infrastructure, right? Made it easier for managing this big data on cloud. And again, when we look at cloud, right? Cloud in the older days, maybe people's perceptions was it wasn't that secure and such, but nowadays, cloud is very much secure, right? And there are also different models for cloud deployment, right? Depending on appetite, right? So there's public cloud, there's private cloud, there's also hybrid models as well. Of course, the reasons being there are some regulatory ramifications, right? some countries, the transfer of client sensitive data cannot be on the public cloud. So this is where the private cloud comes in. But nevertheless, as we go into the future, I'm sure these things will change. It's an ever, evolving market in the cloud space as well, right? We ourselves within the Finastra umbrella are talking to a lot of clients as well who are venturing into this cloud. They want to see, okay, what different types of cloud providers are there? I mean, there's, of course, the typical main ones would be, Amazon, we've got Microsoft, we've got Google, maybe in China and all that, we've got Ali, so different type of cloud providers. And we need to be able to work with the different types of providers, because you need to also have the different access as well as security mechanisms in play, where these different banks want to utilize them for the different types of hybrid models as well. Some other things on the cloud, I would say, is the time taken, right, for testing. Let's say, for instance, right, when we look at evergreening, right? I mean, I think Nikhil spoke about this before as well. When we look at evergreening, let's say that's one of those things where, typically in the normal world, what happens is on-prem, right? A subset of, I would say, resources will be needed to be onboarded. These type of resources, I mean, there's a lot of time taken to enable these resources to go into a project, perhaps for an upgrade. And why would most banks want to do an upgrade is obviously because they want to make sure they're able to leverage upon the new functionality, which is offered by the solution providers. And to be able to do that, they'll have to ensure that they, bring in their team. And that typically takes months of planning and execution for services such as UAT, SIT, to create these different types of functionality and usages of that. And when I look at cloud in nature, right? When, let's say, for instance, if this information can be deployed on that cloud environment, and if these certain types of different services, let's say, for instance, when I talk about upgrading, give that upgrading aspect perhaps to a vendor, right? Because that is not like a money-making thing, right? You want to release your resources to bring in more revenue. So give that different types of pockets of capabilities where a vendor can take that on. They can do that evergreening for yourself. They don't have to really struggle, or the banks don't really have to struggle, right, to go through that entire 6 months, 1 year project just for an upgrade and such. Keep that off. Focus on your revenue generating purposes as well. Again, nowadays, if you think about it, even banks, right? There's a lot of banks out there who are also creating their own in-house applications, right? Because they have the whole IT within the industry. They have the knowledge as well. So where they see there's certain types of components which is not readily available within a solution, what they would do is they will build it. And now, because the deployment of cloud is much easier, they can even push it in the cloud and sell that off to others who might have interest in that. That becomes revenue generating again. So cloud makes that possible. Whereas in the past, you can't have, another bank or another, user wanting to be able to use a current bank system, which is on-prem. No way. There's so much security around that. Whereas on the cloud, they can deploy it, give the necessary nodes, permissioning, and others can use it through the different types of licenses which are available as well. So apart from that, what I can also think about is if you really look at cloud, innovation, right? When we look at agility and innovation, like I just spoke to you about, banks have their own IT departments. They can leverage on these developers creating these different kinds of application for accelerated information, right? The user experiences. So when we look at user experiences as well, right? They get a much more better, I would say, sexier UI, UX, cloud security, all these different applications which are being deployed, for the different types of upgrades which is out there. On the ROI side of things, when we look at ROI, of course, if you think about different solutions, I'd say each different solution will have its own hardware, software requirements, right? And for each one of the hardware, software requirements, you need different sets of experts to maintain those requirements, right? So when we look at that, right, there will be a more efficient use of resources, right? Letting the staff to focus on revenue, again, like I said, revenue generating income, deploy it on the cloud. Maybe you can have a hybrid cloud model. I mean, you can save costs on infra as well, right? There's a more predictable spend, less cost for hardware, upgrades and infrastructures are a lot more predictable. That's something that I would say, at least on the cloud stand for now, Nikhil.
Very interesting. Arvind, I think, you just covered everything in terms of, how not just the benefits of a cloud, but, specifically even for lending, how it's, really benefiting, right? And one thing I can clearly, one thing that has stood out for me was how, banks can have a updated or, the best in class solutions all the time. So they don't have to wait for certain things. All right. So, and
Indeed.
I think we are getting closer and closer to the ending time. But I do want to, get a few more questions answered, and I do have a list of questions also on from the participants. So I'm going to ask ask our panel members, maybe to focus on the key aspects of the questions. And I want to go back to operations, right? Jayanta, how crucial do you think you need to evaluate a borrower as not just as a standalone entity, but as a part of a value chain or an ecosystem? How important is that?
Okay. Let me start by looking at the second polling question, where we always say customers are right and intelligent. We should also say always that participants are quite knowledgeable and usually more knowledgeable than the panel. So the 3 points they looked at: improve customer experience, credit risk, and operational risk. These three were the highest scoring points there, right? The, and all these three are addressed by the ecosystem or the value chain that we talk about. Now, why does the ecosystem come, first of all? It's important, but why does the ecosystem? We have a corporate. The corporate can be a big corporate, or today's scenario, the corporate can be replaced by a procurement platform, a platform or a e-commerce platform, which is the center of ease of activity, where transaction happens. So the corporate or the e-procurement platform or the transaction platform is the provider of service. Okay. They generate orders. So for the corporate, there is no dearth of getting bank. But the corporate wants to reduce their lending because to keep their financial ratios and the interest margin lower. But on the left side of the corporate are the suppliers or the vendors who are executing those orders being generated by the corporate. Like it or not like it, in developing countries, and also to some extent including Singapore, but more in developing countries, these suppliers are more MSME, which don't get financed by banks typically because banks want collateral. And the people, if for every work they do, if they have to generate an asset, they can't work. So there's a working capital short. On the right side is, after the work is done and delivered to the corporate will process and deliver it to the distributor or the retailer. Now, those people also start adequate financing because they have to pay the corporate in 30 days, 60 days, 90 days, or the platform, whatever it is. But guess what? Sometimes their cash cycle of selling to the ultimate buyer can be a B2B or ultimate buyer can be B2C, may not be 30, 60, 90 days. If they give credit, they sell goes. That is the concept of the value chain. Value chain concept is the anchor, whoever it is, can reduce his cost. Two sides can get finance. And the only way to do it is not looking at each SME on the left side, the vendors on the right side, the dealers in isolation, but as a part of the value chain. Earlier, banks used to do it, or earlier used to do it. Take the corporate and give a sub-limit here. Okay, after 10 million, 1 million sub-limit to your supplier on the left side, 1 million to the right side. That doesn't serve the purpose because that 1 million goes to the top 5 vendors and the top 5 dealers who, any case, banks are willing to finance. So in the value chain concept, you have a linkage with the entire value. You finance everybody A to Z, E to E. It's not only E to E, it's A to Z. You start from the smallest vendor on the left side to the smallest dealer on the right side, and we do that. In Validus, we do that in Singapore. The left side we do very well. Singapore doesn't have a big distribution market, small city. In Indonesia and Thailand, we do both sides. the left side and the right side. The beauty of this is you don't need to analyze each of the small guys separately. You analyze the entire transaction. You see the entire transaction once you link it up. You see the supply being happening, the corporate being processing, and it going to the dealer, dealer being selling, money coming back, money coming back, money coming back. The entire cycle. And the same financing you do thrice. You first finance to the supplier, then you give a credit to the corporate, then you give a credit to the dealer. Okay, so you take your returns by financing 3 times the same transaction. They don't get hurt because the interest is split between 3 parties now. The corporate takes a small interest. The 2 sides, the left and right, pays you higher interest. You can risk-based the entire thing. The left side can be pre-shipment, can be higher risk. The right side can be lower risk. The tenor can be dovetail as much, and each ecosystem can have their own pricing and tenor. So it's a very important marriage in the system. And it only works if you don't cherry pick. If you cherry pick and say, Mr. Corporate, I will do your top 3 vendors, top 3 suppliers, dealers. But that in any case gets, right? That in any case gets 20 years they're doing business, right? So,
Right.
and another important thing is this is all short-term financing and money has to be on tap.
Right.
You see the transaction like in Validus, if from this side the work is done and come to the corporate, they send the invoices to us or our portal or through email. By 2 o'clock same day, receiving by 5 o'clock same day, the money goes out. 2 hours turnaround time. Similarly, the corporate will issue an invoice to the dealer before the dealer gets the goods. 2-hour turnaround time, the corporate will get the money. So money moves in 2 hours, the goods moves in 1 day. Yeah. That is the beauty of the value chain.
Fantastic.
And that, and in the entire system,
Yeah,
believe me, you have to be digital, you have to be data centric. The credit model has to be running like this. Otherwise, if you have postman or couriers to carry tons of transaction this side and that side,
Yeah.
then I think value chain we have been talking about for 20 years, it did not succeed earlier because digitization was not. The
Yep,
only way to
makes
go
sense.
about value chain and the entire system is digitization. Win-win-win for it.
Makes sense.
That's what was my thought in value chain.
Jayanta, this is a master class. I wouldn't even call it a webinar. This is a master class. That was so beautifully explained. Thank you so much.
Well, I've done it 4 times in my life, 3 times in a bank partially, but now with digitization, completely invalid.
Indeed. That's why all the pearls of wisdom are so helpful. It's time for I know we are running very short on time. I'm going to quickly start the 3rd poll question. I'm going to launch the 3rd poll question, and more towards I would say towards the ending, right? This is the right question. What's the must-have for a commercial lender of the future? What's the must-have? A cloud-based architecture, the AI-boosted relationship manager, partnership with fintechs, or is it automated risk evaluation? Wow, the answers are flowing in, and again, neck and neck, almost across. I don't know whether the panelists answers given by the panelists are influencing the answers already, because I see automated risk evaluation getting top marks here. So amazing. All right. So I'm going to jump quickly. Quickly sharing the results. As I was saying, maybe I don't know whether the pearls of wisdom coming from the group here is influencing in many ways. But yeah, automated risk evaluation stands topmost here. Fantastic. I do want to make sure that we don't miss out on the regulatory front, right? That is such an important aspect of the whole data and digitization and technology. What can be used, what can't be used. So I'm going to bring in Chidambaram. I'm going to bring in you over here and say, what do you think is what's the role that regulators and regulations as a whole, what's the role that they will play in corporate lending going ahead?
Thanks. So regulation and regulator is a very vast field. There is no end to it, and each aspect of lending is touched in some form of the regulator. So the easiest way to explain it to a layman would be to relate it like a traffic cop, or the way we drive in the roads. So how is it getting regulated? How is the traffic regulated in the roads and in the intersection? Some places it's fully automated. In some places we have the traffic cop who regulates not only the intersection but also the roads. Similarly, regulation in different countries can be broken up into two parts. One could be, a prescriptive, that is rule-based, or else it could be principle-based or guidance-based, or a mix of both, depending on what it is. And ideally, if you see, you could see that developing countries would have prescriptive or rules-based regulations, while you move towards the developing countries, it moved towards more of guidance based, and somewhere economies who are in the middle or cusp of it will have a mixture of both of them. But the bottom line is that all regulations, the prudential norms of lending require what we just discussed, as Jayanta was also mentioning, that you have a credit assessment, you do the assessment based on which you decide how much you want to give credit to, or how much you want to lend to. And it could, in some geographies, regulators will prescribe you that this is what I want. You want to give him a non-fund-based limit, you should do an evaluation for a fund-based limit and then only do it, and some you may not. So there, but the bottom line is regulation is a must for all, lending and industry. Now, recently, just for everyone's audience, I'll just divert a little. So there are a number of regulations which are happening and which regulators are also working around. One is a central bank digital currency, CBDC. Now, this is something which, if you look theoretically or academically, could bring an end to all banking, because, central bank could be the one issuing it and controlling everything, and will have direct accounts, so no intermediary required. So therefore, you will have regulations as to what is the quantum of CBDC which will be allowed and how it will be monitored, how it can be used, etc. The second one, which is very important and which Arvind was mentioning earlier, is your DLT, or the blockchain or distributed ledger technology, which can actually improve your negotiation, execution, transaction management, and transferability of loans. So if you have loans which you can be coded, or everyone can participate, what will also help is presently there's a big difference between the bond and the loan market. By having this technology, it will help to bridge the gap between loan syndications and the bond market which we presently see. So there's an important piece of regulation which we'll have to see how it works around. Apart from that, I can think of CCPs, Central Clearing Counter, another institution which came up after the GFC to ensure the stability of the entire financial system. And in the big currencies, all the FX and IRSs are mandated to be cleared through CCPs, wherein the credit risk is taken by the CCP and not bilaterally between two financial intermediaries. So therefore, if something similar can also happen for loan syndications, and loans could also be, these syndicated loans could also be cleared through a CCP, that will be a sea change, and then loan syndication loans and systems would just change. Related to that, in the last 2 years, and which every one of us is now hearing, is on climate change. So, that's, the ESG piece. So regulations, you can see a lot of regulators also working towards ESG, wherein, they're trying to help as to, we'll give you subsidy, we'll give you benefit in terms of capital requirements, etc. if the loans that you source are, green or ESG compliant. So that's another piece of regulation. Last but not the least is, how each regulator decides on what regulation to use. And commonly, everyone knows of Basel 2, 3, and 4. So presently, if you see, there are a number of countries where, Basel 4 is being implemented. Next year, there are a number of countries which are implementing Basel 4. And we have countries within Asia itself who are still on Basel 2, who have not even moved to Basel 3, forget about 4. So what does this, help this loan syndication market? So loan syndication market, just to, give a high level overview, you have the primary members, primary loan syndicate members, and the secondary loan syndicate members. So the primary members have, the benefit or the advantage of sourcing, of pricing, of distribution, of appetite, etc. While the secondary loan participants, they're basically, these loans help them to diversify their risk, enter geographies where they have no presence, or enter fields or sectors where they don't have any risk. Now, if you have different regulations, one geography under Basel IV and another under Basel II, it gives rise to a lot of regulatory arbitrage. You could do a lot of arbitrage by buying and selling loans between geographies. So in short, in a nutshell, regulation, we can go on, and I don't think we have enough time now. We are already we have reached a limit. So it's critical and vital for any financial ecosystem. I'll end there. Thanks.
Wow, that loan arbitrage, it piqued my ears very quickly. That very interesting. So rapid fire. We are completely out of time, but I do want to get a rapid fire in for Arvind, because I don't think technology discussion can be complete when we don't talk about fintechs. So Arvind, rapid fire, and I would maybe 30 seconds or less. Do you think fintechs, when it comes to the corporate lending space, do you see them as, should banks see them as competitors or collaborators?
Well, I think it's of course the later. Definitely, it is collaborators. So financial institutions need to promote the culture of innovation. So fintechs need to be there, right? We need to be able to open up the different types of platforms, right? To extend the different types of requirements which is needed. Like Chidambaram was saying, right? It's evergreening and changing, right? So many new regulations coming up. We don't want to wait until a specific vendor creates and customizes and develops that. We want to leverage these fintechs. Perhaps somebody has already done it. Let's piece in the puzzles, right? Plug it into the ecosystem and create that end-to-end requirement which is needed for the banks. That's what I would say.
Best in class solutions for the client, right?
Indeed.
Fantastic. Gentlemen, thank you so much. It's been such a wonderful discussion, and I hate to say that the 60 minutes are over. I can tell you that we are 3 minutes over. Typically, people start jumping off. I think this has been such a fascinating discussion that we have more than 95% of the participants still on. But thank you so much. You're completely out of time. Thank you so much, my dear panel members. Being so generous with your insights, and I hope the audience, they were able to take back something new or the other that probably did not know before. Thank you so much,
Nikhil.
and have a wonderful day ahead.
Have a
Thank
good
you,
day,
everybody.
everyone. Bye.
Bye.